So it's February 2026, and I was looking at the morning briefing over coffee today, and the numbers are honestly, they're just, they're hard to wrap your head around.
Mm,
The World Economic Forum has officially pinned geoeconomic confrontation as the single biggest risk to the planet.
number one.
Number one. And when you look at the receipts, they aren't wrong. Global military spending just smashed past $2.7 trillion.
It's a staggering amount of money. It really is. And it represents a historic shift, one that I don't think people have fully appreciated yet.
Right.
We're seeing NATO members, countries that for years, frankly, dragged their feet on hitting even modest targets, now committing to spending 5% of their GDP on defense by 2035.
5%. That feels massive. I mean, the old argument was always about getting to 2%.
It is massive. It's effectively the largest peacetime military expansion we've seen in decades,
Mm.
maybe ever.
Mhm.
And it signals this fundamental change in how governments are prioritizing their checkbooks.
And that's exactly what we're digging into today. We're unpacking this fascinating, if maybe a little terrifying, chapter from quirky journals called Geopolitics for Investors, Reading Tensions Without Speculating. Because let's be honest, you see those headlines, and the natural instinct for anyone with a savings account, a 401k, is to think, okay, the world is arming up, I should dump all my money into defense stocks.
That's the knee-jerk reaction.
Mm-hmm.
And it is precisely where most people get burned.
Mm-hmm.
The core problem, and what we're going to explore, is that most investors just fundamentally misunderstand how a war economy actually works. They try to predict who's going to win a conflict.
Which is basically gambling.
It is gambling. It's
Yeah.
trying to be a general instead of an investor. And unless you have a seat in the situation room, you have no idea what's going to happen next week.
Right.
So instead of guessing, you need to understand the structural economic realities, the plumbing that actually drives these markets.
So our mission today is to walk through that disconnect. We're going to look at why these economies break all the normal rules, this sticky concept of the sunk cost fallacy that keeps zombie projects alive forever, and the hidden bills that we all end up paying for it, usually without even realizing it.
And then finally, we'll break down a framework for how you can actually navigate this landscape without needing a crystal ball.
Okay, let's get into it. So the source material starts by pointing out this huge disconnect between ideology and economics. In the regular world, the peacetime economy, efficiency is king.
Right. If a company's bleeding money, it dies. If a government program is just lighting cash on fire, voters usually get angry.
Usually.
In a normal economy, the primary question is always, can we afford this? Voters hate waste. If a bridge costs 10 times what it was supposed to, people get fired. Heads roll.
But when you shift into a war economy, or even just a scenario where the government claims there's an existential threat.
All of that logic just evaporates.
Completely.
It just flips on its head.
Yeah.
It does. The question shifts from, can we afford this, to how can we not afford this?
That's a powerful reframe. It's like the price tag suddenly doesn't matter because the alternative is, well, losing.
And nobody puts a price on survival. And we've seen this play out in real time. Look at Europe. For decades, nations like Germany, Poland, incredibly fiscally conservative.
Oh, budget hawks.
Exactly.
Oh.
They wouldn't meet NATO spending targets because they had domestic priorities, hospitals, schools. But almost overnight, that changed. Germany announced a 100 billion euro special fund. Poland is aiming for 4% of GDP.
But wait, let's pause on that. It's not like they just found that money. It has to come from somewhere.
It comes from borrowing or from cutting other sectors. But the ideology, the fear of the threat, it just overrides the economic math. And this is where you get a broken feedback loop.
Okay, what do you mean by that?
Well, in the civilian market, if you make a bad product, you go out of business. The market punishes you immediately.
Right. If I make a smartphone that catches fire, my stock tanks. Game over.
But in a war economy, there are these huge time lags. You might spend billions on a weapon system today and not know for 20 years if it actually works in combat.
20 years! So there's no immediate punishment for a bad idea.
None. And that's compounded by secrecy. The source mentions a U.S. Government Accountability Office report, and this is startling. It found 98 major defense programs were collectively $402 billion over budget.
$402 billion. That's an insane number to just be over budget. That's the GDP of a country vanishing into cost overruns.
It is, but because of classification, you can't really audit it. You can't just walk in and ask to see the receipts for a classified stealth program. And if you try to question it politically...
It's framed as unpatriotic. Why do you want us to be vulnerable?
Precisely. So you get this ratchet effect. Spending goes up easily, but it almost never comes down. Even when the threat recedes, the spending it stays on that new, higher plateau.
Which leads us right into the next big trap from the text, the sunk cost fallacy. Now, I think most of us know this from our own lives. Like fixing an old car that keeps breaking down just because you've already spent $2,000 on it, you feel like you have to keep going.
To justify the money you already lost, that's the psychology. But in defense economics, it's not just psychology. It is structural. It's baked in.
How so?
We're talking about projects that take 10, 20 years to build. In that time, costs double, technology fails, the strategic need might change completely. Rational economics says, cancel it. Cut your losses.
But in a war economy,
They almost never do.
and the source brought up the AUKUS submarine program as a prime example of this.
Yes, the research from King's College London on AUKUS is fascinating. It's a project that spans generations with costs in the hundreds of billions. It just becomes too big to fail.
Even if the strategy changes.
Even if drones make submarines less relevant in 15 years, you can't stop that train.
So why? Is it just stubbornness? Or is there something else keeping these zombie projects alive? Because $400 billion suggests more than just bad habits.
The source identifies 4 institutional forces that make this spending so sticky. The first is the revolving door.
Explain that one.
It's simple, really. The officials who manage these government programs often end up working for the very contractors they were overseeing once they leave public service.
Ah, so you don't want to cancel the project that might be your future employer. That's cynical, but it makes a certain kind of sense.
It's a perverse incentive structure. But the second force is even more interesting, political engineering.
This sounded like something out of a movie, but it's apparently just standard procedure.
It's not a conspiracy, it's just an incredibly smart business strategy. Defense contractors don't build a jet in one factory. They deliberately spread the supply chain across, say, 40 different congressional districts.
So the landing gear is in Ohio, the electronics in California, the fuselage in Texas.
The software in Virginia? Exactly.
That's devious. So if a politician votes to cancel the jet,
They're voting to kill jobs in their own backyard. They are firing their own voters.
it makes the program politically bulletproof. You literally can't kill it without committing political suicide.
Exactly. And then you add classification. The public can't audit what it can't see. And the fourth force, budget hoarding.
Use it or lose it.
On a billion-dollar scale,
Mhm.
a military branch won't cancel a bad project because if they give that money back, they lose that budget share to another branch next year.
Wow.
So for you, the listener, the big takeaway here is that defense revenue is totally different from civilian revenue. It's predictable, it's sticky, it's almost insulated from reality.
Okay, so the spending is locked in. It's climbing to that 5% GDP target. But that doesn't mean it's free. And this gets to the most important part for the average person, the hidden bill. Because when we hear $2.7 trillion in military spending, we think, okay, maybe my taxes will go up a little. But the source argues it's much more insidious than that.
It is. The text calls it the illusion of direct costs. We focus on the budget sheet, but the real cost is what economists call crowding out.
The guns versus butter trade-off. Classic Econ 101.
It is. But think about what it means in the 2020s. It's not just about money. It's about talent and resources. If you have the best engineers in the country, the brightest minds from MIT, from Stanford, working on missile guidance systems,
Then they aren't working on clean energy grids or designing better medical tech or solving climate change.
exactly, you are draining the brain power from the civilian economy. And it's the same with materials. If you're using massive amounts of steel, titanium, rare earths for tanks,
They aren't going into electric vehicles or new bridges,
which creates supply bottlenecks.
drives up prices.
Right. It creates inflation in the civilian economy. So you pay more for your car, for your house, for groceries, because the resources are being sucked up by the defense sector. The war economy cannibalizes the peace economy.
So we pay at the register, not just on tax day.
And speaking of paying, there's the inflation tax.
Yeah.
Governments rarely raise taxes enough to pay for wars. Voters hate tax hikes. It's political suicide. So what do?
They print the money,
They expand the monetary supply they borrow.
which devalues the money we already have in our savings accounts.
It's a hidden tax. It erodes your savings and your salary, but it's harder for voters to protest because they can't point to a specific line item on a pay stub. They just feel life getting more expensive.
And maybe the saddest part of this that the source mentioned is the intergenerational inequity. That sounds heavy.
Yeah, it is. Modern weapon systems last 30, 40, 50 years. When we borrow to build them, we are financing consumption things that exist to blow up with debt that future generations have to service.
We're putting today's safety on our children's credit card.
That's a good way to put it.
Hmm.
And that debt reduces their ability to fund their own schools, their own hospitals. We are borrowing from their future prosperity to pay for our current security. It's a drag on future growth.
That is a sobering thought. Okay, let's take a breath there. We've established the system is inefficient, sticky, and expensive in hidden ways. But this is a deep dive for investors. We have to navigate it. The source mentions a framework for investing without crystal balls.
Right, because the worst thing you could do is panic. The first rule mentioned is the Ken Fisher rule.
Which is?
Geopolitics rarely causes long-term bear markets, unless global trade is physically broken. The economic machine usually keeps chugging along. Panic selling your portfolio because of a scary headline is almost always the wrong move.
So don't panic, but where should we look? If we aren't just buying the tank manufacturers, what's the play? The source suggests looking at supply chains.
This is strategy one. Don't speculate on if a conflict will happen. Look at the vulnerability.
Okay.
The source uses rare earths and chips as examples. China controls something like 80% of rare earth refining. TSMC in Taiwan makes 90% of the world's advanced chips.
Right. Massive choke points.
Huge. Now, a speculator tries to guess, will China invade Taiwan in 2027? That's a coin toss. A smart investor looks at that vulnerability and says, regardless of war, the world needs to de-risk.
Because even just the threat is enough to make companies nervous.
Precisely. Everyone, Apple, Tesla, the U.S. military, they all need an alternative. So you invest in the alternatives. You invest in new factories outside the conflict zones, in recycling tech for rare earths. These sectors have to grow, even if a war never happens.
That's a key distinction. You're betting on the preparation, not the conflict itself.
Correct. Strategy two is watching market signals. The bond market and currency markets are often smarter than the news.
The thermometer of risk.
Yes. When rhetoric gets hot, ignore the politicians and look at the money. Watch safe haven currencies like the US dollar or the Swiss franc, and watch bond yields.
Why bond yields specifically?
If bond yields spike, it means the market fears default or currency debasement. It's demanding a higher return to lend to the government. If the news is screaming World War III, but bond yields are flat, the smart money isn't buying the hype.
And strategy three.
Friendshoring. This is structural. Capital is moving to places like Vietnam, India, Mexico to diversify away from China. This isn't a short-term trade. It's a massive replumbing of the global economy.
Building factories takes years. It's not something you flip in a week.
Exactly. So investing in the beneficiaries of that shift, the infrastructure in India, the manufacturing in Mexico, is a way to play the landscape without betting on a specific battle.
Okay, I have to ask about the trap. The source specifically warns against just buying major defense stocks when a crisis hits. It seems so obvious, though. War starts by Lockheed, right?
It seems obvious, which is exactly why it usually fails. First, it's already priced in. By the time you read the headline, the pros and their algorithms have already made the trade. You are buying the top.
You're late to the party.
Very late. But second, these major contractors are what the source calls quasi-utilities. They're steady, sure. They've guaranteed government contracts, but they've capped upside. The government regulates their profit margins. They aren't going to give you explosive tech-like growth.
So where's the growth opportunity then?
Second-order effects. The source points to cybersecurity.
Cyber. That makes sense.
Corporate spending on security goes up, regardless of whether there's a physical war or just a cold one. Every bank, every hospital, every retailer needs more cyber defense.
It's non-optional.
Right. Also, strategic materials, domestic energy, semiconductor manufacturing, things being heavily subsidized by governments, and satellite communications. Modern life runs on data from space.
So instead of buying the company making the metal tank, you buy the company securing the data network.
Exactly. The picks and shovels of the 21st century. And finally, the ultimate defense is just diversification. Since you can't predict the outcome, your portfolio has to be able to survive multiple scenarios.
Okay, let's bring this all together. We know war economies run on ideology, not efficiency. We know the sunk cost fallacy keeps massive projects alive for decades thanks to political engineering.
And those supply chains spread across 40 districts.
Right.
And we know the bill is paid through hidden inflation and debt that steals from the future.
And for the investor, the lesson is clear. Stop trying to be a general. Don't bet on the winner. Bet on the structural shifts, the supply chain changes, the de-risking that happen no matter what.
That's the core message. The source calls it avoiding the speculation trap. The most dangerous thing isn't the geopolitical event itself. It's the arrogance of thinking you know how the politics will play out.
Here's where it gets really interesting for me, though. We talked about how sticky this defense spending is. Once it ramps up, it rarely comes down.
Right. It creates its own momentum. It becomes part of the economic fabric.
So if we're entering this era of massive spending, and that spending creates a feedback loop that resists correction, are we moving toward a world where the war economy is actually just the permanent economy?
That is the provocative question to leave with. If 5% of GDP becomes the floor, not the ceiling, and if security trumps efficiency in every decision, then the rules of the last 30 years of globalization are effectively gone.
We might be looking at a totally different operating system for the global market.
We might be. And in that world, inflation might not be a bug. It might be a feature. It might be the only way to keep the machine running.
And if that's the case, what does that mean for the value of the money sitting in your savings account right now? If that inflation tax is the only way to pay for it all, that change in your pocket might be the biggest casualty.
It's a reality check. We have to stop thinking of geopolitics as noise that happens over there and start seeing it as the structural plumbing of the market we all live in.
A lot to think about. Thank you for guiding us through the fog of war economics today.
My pleasure. It's always better to look at the machinery than just the headlines.
And thank you to everyone listening. Keep questioning, keep learning, and we'll see you on the next deep dive.